Charles, welcome to this conversation about markets for our clients in Colombia. We really appreciate your time. So there's a few questions that are in the heads of our clients, and these are the ones that I would like you to address during this conversation. The first one being, what do you think are the more significant risks in the markets for investors in the next 12 months?
Okay, there are two risks that are somewhat interrelated. The first risk is the fear that the US and Western Europe will slip into a recession and a deep recession. I think in the case of Europe, particularly continental Europe, it's widely understood that that part of the world is likely going to be in a recession in the back half of this year as power prices and natural gas prices really start to take a toll on the economy, both crimping consumer spending as well as harming industrial production. In the United States, it really remains to be seen. The one thing arguing against recession in the United States and against a prolonged recession in Europe is that the employment picture is very, very good. There's lots of demand for labor in the United States. There has been a few layoffs in the tech sector and in some of the higher white-collar jobs, but there is an absolute voracious appetite for labor in the United States. The jobs number that came out last Friday on August 5th was 500,000 new jobs. Very, very attractive. It's usually you start to see some weakness in the labor market concurrent with the economy weakening, and we just haven't seen that. In fact, we're seeing lots of complaints about labor shortages in sectors such as construction, healthcare, logistics, et cetera, et cetera.
Perfect. There's another question that we've been discussing recently with clients, and it's about the market uptick that we saw in July. Is it purely driven by earnings that were better than the market was expecting?
No, I think it has to do with the second main risk in the market right now, which is there has been some optimism that inflation has peaked. And with the United States Consumer Price Index data that came out on August 10th, that came in well below expectations. And so as we record this on August 12th, this has been a very strong week in the equity markets after a very strong July. And key to that has been an expectation that inflation won't come down quickly, but that the month-over-month inflation readings, which is what the markets really focuses in on, not the year-over-year, but the month-over-month, that the rate of change was really starting to slow. And inflation kind of has three buckets, if you will. There is goods, there's services, and there's housing. Goods prices are starting to come down and decelerate a little bit. So they're still going up, but their rate of acceleration is coming down because supply chains are starting to get better and the labor situation is starting to get better. And housing is starting to peak and come down as well. The part of inflation that's still quite strong is in services due to sort of labor shortages. But on balance, over the last couple of months, inflation data, while still high versus recent history, it's no longer accelerating. And that's important. And the market has liked that because it feeds into an expectation that the terminal rate hike by the Federal Reserve in terms of moving up short-term interest rates, maybe it'll be more like 3% as opposed to 4% or 4.5%. And the reverse holds true too. On days when you're seeing the market really weak, often why it's being weak is there is this fear that inflation, in fact, is not rolling over and that the Federal Reserve will have to hike interest rates, not just to 3%, but to more like 4.5%. And short-term interest rates at that order of magnitude would absolutely put stress on consumers and home buyers and on small businesses, most of which borrow money off of the short end of the interest rate curve.
Perfect, Charles. Another question that we've been discussing often these days is about earnings. Do you think that the picture that earnings are showing right now is a more optimistic outlook than where they were 6 months ago?
No, earnings expectations have come down, which is consistent with the lower rates of economic growth we're seeing. We went into this earnings season, so at the end of June, forward earnings estimates on the S&P 500 were about $238. They've come down to $225 right now, so they've come off a bit. And one of the big reasons for that is companies are doing really, really well in terms of revenue growth, but cost pressure, whether it is because of supply chain shortages or labor shortages or higher input costs because of higher commodity prices, have really pinched margins, and margins had been at record highs as at the end of last year. So corporations, in fairness, had some room they could give in terms of margins. So the earnings picture continues to come down, and that, quite candidly, will be a likely headwind to equity markets over the next couple of quarters. It wouldn't surprise us if there's a bit of a tug of war in terms of improving sentiment, because inflation starts to decelerate versus the earnings picture, which is also starting to unwind and be a little bit less rosy than was the case 6 or 9 months ago.
So would you like to expand about the buying opportunity that we have right now?
Yeah, so I think, we get the question a lot, is this a good buying opportunity for stocks? And quite frankly, the answer never changes, right? It depends on your time horizon. If your time horizon is next Friday, this is an absolutely awful time to buy stocks, because stocks are over shorter periods of time, 2-3 years or less, are inherently volatile and inherently unpredictable. However, they get more and more predictable as you extend your time horizon. I would note that even with this rally we've seen in equities over the last couple of months, we're still a good 15% below the record highs. And valuations are much better than where they've been for a couple of years. So is it a good buying opportunity on a 12-month time horizon? Flip a coin, quite candidly. However, I would say over a 3 to 5 year time horizon, we see all sorts of ways that investors can get a very handsome rate of return, broadly in line with the long-term return on equities, which is about 9% a year in US dollar terms, give or take.
And do you think there are any opportunities, in particular equities, at this moment?
Yeah. Well, the old saying, right? Never let a crisis go to waste. And we apply that thinking here at Seidel when we get volatility in the equity markets. So at a company specific level, we've used the sell-off, and especially the sell-off we saw, from February to May, to really improve where we could the quality of the portfolio, and to buy some stocks of companies we've always admired, but we thought their share prices were a little bit too dear. So, for example, just in the last few months, we've added in the French luxury conglomerate, Louis Vuitton, Moët Hennessy. Just a couple of weeks ago, we took a position in the cosmetics company L'Oreal. We bought shares in Thermo Fisher, which is a super high quality US healthcare and industrial interest, again, because we have a lot of visibility on their growth of those specific companies, and their share prices had finally come down to levels that we thought were a bit more reasonable. Geographically, US stocks are no longer at close to record highs, which is what they were when they were at 22 times forward earnings. They were at multi-year highs, not as expensive as during the tech boom of the 90s. But still expensive relative to the last 15 years or so. The big valuation opportunity for stocks are non-US stocks, so Japanese, European, Canadian, and Australian stocks. These stocks are all trading well below their long-term averages. Now, the issue with the non-US stocks is the most likely catalyst to get these stocks moving is better sustained global economic growth. And right now, as we record this in August of 2022, economic growth expectations are decelerating, which is not typically going to be a favor to the relative outperformance of non-US equities, or particularly strong absolute performance of non-US equities as well. But non-US stocks are undeniably cheap.
Do you have Any message for investors sitting in large cash positions at this moment?
Well, it really depends circumstance by circumstance and on risk appetite. Cash happily, so US dollar cash actually has a decent yield on it for the first time in 15 years just about. And so that is very, very happy news. There's actually some sort of return on a money market fund. But it depends, right? The best asset class for protecting wealth over the long period of time is high quality stocks that compound free cash flow. So high quality businesses with strong balance sheets that pay dividends, that reinvest their profit in organic growth opportunities. High quality stocks will outperform cash and outperform bonds by large amounts over long periods of time. So a conversation we have, and as you know, Oscar, the way we work with clients is we talk about their and their family's investment objectives, the kind of rates of return that the various asset classes offer, and what is the most conservative asset mix we can take to achieve those return objectives. And then in terms of getting invested in the stock market, often we find that it is better to go bit by bit. So if the ultimate investment in the stock market for a client might be $100, I would certainly suggest, putting to work $35 to $50 today, maybe doing another $25 as we get into the fall, and then waiting until the start of the new year in terms of timing that last $25. Getting market timing and trying to get market timing right is a bit of a fool's errand, but we do need to recognize that many investors are nervous. They like the sense of control of a steady deployment of cash into the market. And so I think for psychological reasons, that kind of staged deployment of cash can actually be quite reassuring and quite satisfying to many of our investors, even though technically, like in a formal academic sense, it isn't necessarily the most astute thing to do. You do need to recognize that people are rightfully nervous, right? This is their savings. They're looking at not just for themselves, but for their families as well.
And just to finish this section, Charles, what are the opportunities you can see right now in the fixed income world?
So fixed income, it's good news, bad news. The good news is that yields are much better than they were a year and a half ago. The US 10-year bond is about 2.8% today, which means good quality US corporate bonds are yielding more like 3.8%, 3.5%, something in that order of magnitude. Which isn't as juicy as maybe the 5% we would like. And, before the financial crisis in 2006, 7, 8, you could get good quality US corporate bonds yielding in that 5 to 6% range. And we're not quite back there yet, but it's a heck of a lot better than the 2% yields we were seeing just, a couple of years ago in corporate bonds, and barely over 1% in government bonds a year and a half ago. So yields have definitely picked up. It looks as though yields are sort of stabilizing here as we have this ongoing tension and push and pull in the capital markets between decelerating inflation, but also decelerating growth. So they can absolutely play a role, not so much in terms of generating great returns, because the yields are going to be what you're going to return, right? If we go into a client fixed income portfolio with a 3.5% yield, that's going to be a pretty good predictor of what that client's ultimately going to earn on that strategy. So it's still not super rich, but it's a lot better than it was. And the good thing too about how we manage fixed income is it's very, very liquid, and we can move quickly. So if an investor thinks they want to add to fixed income, we can add a lot of money in a day. If an investor thinks they want to get out of fixed income entirely because they want to get into something either more aggressive or more stable, we can do that too. So fixed income, no, it's a very good building block for most investors in their portfolio, because it generates a yield, again, above what they can get in a bank account. but it doesn't have the volatility of the stock market. But over long periods of time, and by long periods, I'm really talking about 10 years plus, you've got like a 90% chance of stocks outperforming bonds cumulatively. So it's always that trade-off. It's always that trade-off of trading off short-term volatility for long-term capital appreciation.
Charles, we really appreciate your answers, and we'll look forward to having you in Colombia very, very soon.
Oh, I can't wait. I can't wait. Okay, thanks, Oscar. Cheers. Bye.